Many people lose money not because they invest in the wrong place, but because they make a few simple mistakes at the beginning. In this video, you'll learn 5 common investing mistakes and how to avoid them. Let's get started. The first mistake is to keeping all your money in a low-interest savings account. Imagine you save $1,000 in a traditional bank savings account that pays very little interest. At first, it feels safe. But here's the problem.
I see that the interest rates are quite low.
If inflation is around 3 to 4% and your savings earn much less than that, your money gradually loses purchasing power. In simple words, your $1,000 may still say $1,000 on your screen, but over time, it buys fewer things. Example, imagine today you can buy 100 grocery items with your money. A few years later, because prices have increased, that same money might only buy 96 or 97 items. That's the hidden cost of inflation. So the better approach is keep your emergency fund in a high-yield savings account, HYSA, if one is available in your country. It keeps your money accessible while earning a better interest rate than many traditional savings accounts. Second mistake is that ignoring your employer's 401k match. If you work for a company in the United States, your employer may offer a 401k retirement plan. Some companies even match part of your contribution. This is often called free money. Example, let's say you invest $100 from your paycheck. If your employer matches 100%, another $100 is added. Now you have $200 invested, even though only $100 came from your salary. Not every company offers the same match, but if your employer does, it's usually one of the best places to start. Third one is chasing hype instead of building a strong foundation. Many beginners see social media posts saying, "Buy this stock, buy this crypto. This company will make you rich." They invest everything into one hot stock or one meme coin. That's very risky. Example, imagine you invest your entire $1,000 in one company. If that company loses 50% of its value, your investment falls to $500. Instead, many long-term investors choose a diversified S&P 500 index fund or total market index fund, which spreads money across hundreds of companies instead of depending on just one. Diversification doesn't eliminate risk, but it helps reduce the risk of relying on a single company. Fourth one is panic selling when the market falls. This is one of the biggest mistakes new investors make. The market drops, your portfolio turns red, fear takes over, so you sell everything. Unfortunately, that's often when losses become permanent. Example, suppose you invest $1,000. The market falls by 20%. Your investment is now worth $800. If you sell, you've locked in that loss. If you stay invested, history shows that markets have often recovered over the long term, although past performance never guarantees future results. Many experienced investors see market declines as opportunities to buy quality investments at lower prices. Fifth mistake is waiting for the perfect time. Many people say, "I'll invest when the market crashes. I'll wait until prices are lower." The problem is, nobody consistently knows where the market's exact bottom will be. Even professional investors cannot predict it perfectly every time. Example, person A starts investing $100 every month. Person B waits for the perfect time, but never feels confident enough to start. After several years, person A has benefited from regular investing and the power of compounding, while person B is still waiting. That's why many investors use dollar-cost averaging, which means investing a fixed amount regularly instead of trying to perfectly time the market. As the saying goes, time in the market is usually more important than trying to time the market. So keep it in your mind that investing doesn't require perfect timing. It doesn't require being a financial genius. It simply requires avoiding common mistakes and staying consistent. Start with a strong foundation, diversify your investments, take advantage of employer benefits if they're available. Don't let emotions control your decisions. And remember, Small, consistent investments made over many years can grow into something much bigger. If you found this video helpful, don't forget to like, subscribe, and share it with someone who is just beginning their investing journey. Thanks for watching, and I'll see you in the next video.